In the volatile world of cryptocurrency, where fortunes are made and lost in the blink of an eye, few names have stirred as much controversy as Donald Trump, the President of the United States. Once a vocal skeptic, Trump posted on Twitter in 2019 to slam Bitcoin and other digital currencies, calling them not money and warning that their value was highly volatile and based on thin air. Fast forward to today. Trump is back in the White House and has undergone a jaw-dropping transformation. He now positions himself as crypto's biggest cheerleader, vowing to make the United States the crypto capital of the planet Earth. During the election campaign, Trump railed against then SEC Chair Gary Gensler for stifling the industry with regulations. He floated bold ideas like a strategic Bitcoin reserve, and he's delivering. Just this past Sunday, Trump posted on Truth Social about creating a U.S. crypto reserve that wouldn't stop at Bitcoin. It would include heavyweights like Ethereum, XRP, Solana, and Cardano. Then on Thursday, he signed an executive order, officially launching an American strategic Bitcoin reserve and digital asset stockpile. So, what's going on here? How did Trump go from trashing crypto to championing it with such fervor? What's the real purpose behind this strategic Bitcoin fund? And what could it mean for the future of cryptocurrency in America? Let's get into it. President Trump's strategic crypto reserve concept has sparked intrigue, drawing apparent inspiration from a bold idea championed by pro-crypto Republican Senator Cynthia Lummis. Last year, Lummis introduced the Bitcoin Act in Congress, which aimed to cement the United States as a powerhouse in the cryptocurrency arena. Under Lummis's Bitcoin Act, the federal government would acquire and hold 1 million bitcoins over a 5-year span, committing to retain them for at least 20 years. This ambitious proposal aimed to signal unwavering confidence in Bitcoin's enduring value while establishing it as a strategic national asset. Trump's executive order, however, takes a different tack. Rather than specifying a fixed target, it directs the Treasury to identify budget-neutral avenues to amass additional bitcoins beyond the 200,000 already seized from illicit activities. The core idea, building a substantial Bitcoin reserve, echoes Lummis's vision, yet the execution diverges in notable ways. Trump's order introduces intriguing restrictions. It explicitly forbids the Treasury from purchasing cryptocurrencies beyond those obtained through confiscation, which seems to clash with his earlier Truth Social musings about a broader crypto reserve. Additionally, the executive order mandates that the government refrain from selling any confiscated digital assets, instead tasking the Treasury to devise strategies for responsible stewardship of this growing stockpile, all in compliance with existing laws. The crypto market, ever attuned to policy shifts, didn't take long to react. Bitcoin and other cryptocurrencies saw prices dip as investors grappled with the disconnect between Trump's earlier promises and the executive order's narrower scope. Enthusiasts who had hoped for a sweeping embrace of digital assets found the reality less exhilarating, prompting a wave of uncertainty rippled through trading platforms. But can cryptocurrencies even be a strategic reserve for a country like America? Strategic reserves are stockpiles of commodities deemed so essential to a nation's economy or security that governments maintain them either as a last resort supply or to ensure price stability. These reserves typically include resources critical to societal function, such as food or energy. Many countries, for instance, hold strategic grain reserves to protect against shortages, while the United States maintains its strategic petroleum reserve to secure oil access during crises. Consider China's strategic pork reserve, which underscores the commodity's significance. With a stockpile of approximately 200,000 metric tons, this reserve aims to stabilize pork prices, ensuring consumer affordability and farmer reliability. Pork is deeply embedded in Chinese cuisine and culture, with the nation's citizens spending a substantial portion of their income on it, more than most other populations globally. Price spikes, particularly during holiday seasons, can disrupt economic and social stability. This reserve was established in 2007 after an outbreak of blue ear disease drove prices upward, sparking public unrest and highlighting pork's critical role. In contrast, the United States Strategic Petroleum Reserve was initially created as an emergency safeguard following the 1973 oil embargo. Designed to hold hundreds of millions of barrels of crude oil, it ensures supply during disruptions. However, its use has evolved. Between 2021 and 2023, the Biden administration tapped the SPR to manage oil price volatility, releasing reserves when costs soared and replenishing them in 2024 as prices moderated. This shift transformed the SPR into a tool for price stabilization, with the reserve now restored to full capacity. Broadly, strategic reserves serve two key purposes: guaranteeing supply in times of crisis or maintaining price stability for vital commodities. Whether it's grain to prevent famine, oil to power an economy, or pork to preserve cultural and economic norms, these reserves act as a buffer against uncertainty. Their effectiveness hinges on the commodity's importance to national interests and the government's ability to manage them strategically. So, does Bitcoin fall under this description? The idea of a strategic Bitcoin reserve challenges traditional logic. Unlike grain, oil, or pork, Bitcoin is not a tangible necessity for survival or economic operation. Its value, driven by speculation rather than utility, lacks the same urgency. The United States does not need Bitcoin, as it needs oil to fuel industry or grain to feed its people. Nor does stabilizing Bitcoin's notoriously volatile price serve a clear national purpose. Its fluctuations matter more to investors than the broader economy. While cryptocurrencies are gaining prominence, their peripheral role suggests a strategic reserve may be more symbolic than practical. However, dedicated enthusiasts and informed speculators have long envisioned Bitcoin and other cryptocurrencies as much more than mere volatile investments. They see these digital assets as transformative alternatives to conventional financial systems. Many true believers confidently anticipate that Bitcoin's value will continue its upward trajectory over time, drawn not only by the potential for significant capital gains, but also by its very characteristic, volatility. In this realm, the prospect of price stability is not only unappealing, but is sometimes considered fundamentally at odds with the spirit of decentralization that defines the crypto movement. Indeed, for those who invest in crypto, the allure lies in the unpredictable fluctuations that create dynamic opportunities for profit. This market environment starkly contrasts traditional financial instruments that prize consistency and predictability. Crypto enthusiasts view volatility as a vital element that distinguishes Bitcoin from fiat currencies such as the dollar. They imagine Bitcoin as a decentralized, non-inflationary alternative that operates outside the strict confines of government-regulated monetary policy. From their perspective, a stable Bitcoin would lose much of its disruptive potential, reducing its ability to challenge established financial systems. Some analysts have attempted to draw an analogy between Bitcoin as a prospective reserve asset and the gold reserves stored at Fort Knox, a colossal, tangible, safe asset repository. However, this comparison is imperfect for two primary reasons. First, gold has a long-established track record as a proven reserve asset with a stable store of value, whereas Bitcoin is still proving its worth as a reliable, long-term asset. Second, Fort Knox was originally established during an era that culminated in the Bretton Woods monetary system, where the US dollar was once convertible to gold at a fixed rate of $35 an ounce. Under that arrangement, the United States was compelled to maintain an enormous stockpile of gold to support its currency. Today, with the dollar no longer tied to gold, the conventional role of Fort Knox's reserves appears increasingly anachronistic. Adding another layer to this evolving narrative, some commentators speculate that Trump might consider employing Fort Knox's gold reserves to acquire Bitcoin. Proponents of this idea argue that such a maneuver would be budget neutral, essentially shifting assets rather than requiring new expenditures. Trump's top economic advisor, Stephen Miran, has in the past floated proposals to liquidate portions of the gold reserve, whether to procure foreign currency, which could in turn weaken the dollar and narrow America's trade deficit, or to purchase government bonds that would yield a steady revenue stream via interest payments. It is worth noting that the ongoing increase in the price of gold has proven beneficial for the U.S. Treasury, which currently holds roughly $800 billion in gold. Were such a strategy to be executed, it could propel Bitcoin's price to unprecedented heights, potentially sending it to the moon and creating seismic reverberations throughout global financial markets. This speculative scenario underscores the rapidly shifting intersection between traditional finance and the burgeoning world of digital currencies. At its core, the debate revolves around the desirability of volatility versus price stability. While many view the erratic price movements of Bitcoin as a critical component of its value proposition, others argue that a more stable price might facilitate broader acceptance. Yet, for many in the crypto community, Volatility is not a flaw. It is a feature that challenges long-held economic norms. As we continue to witness dramatic changes in both global finance and technology, it remains essential for investors, policymakers, and everyday observers to engage in these debates. Whether one regards Bitcoin as a high-risk speculative asset or a revolutionary tool that could redefine the future of money, the discussion promises to be as dynamic and transformative as the technology itself. What's your take on this issue? Let me know in the comments and check out our latest videos. Thank you.